Today on Finance at 5, the S&P TSX Composite fell a total of 2.7%, making a week loss of 8.84%. Now, it actually opened a lot worse in the morning, opened up around -4%, but has recovered since then. A weird, strange thing going on. Not too sure exactly what it is, but if you go on Yahoo Finance, for some reason, it says it's up 1.8%. That happened in like the last minute trading, but overall, can't find anything else on that. But with this sharp drop in the stock market this week, there is actually an interesting opportunity, with some stocks just dropping about 15% over the coronavirus. It doesn't quite add up. I'm not sure how much value can be lost just through what's going on there. So it might be an interesting time to buy stocks if you're looking, because there could possibly be some interesting return possibilities. The S&P 500 fell 83 basis points on the day, making a week loss of 11.5%. Overall, it wasn't too terrible of a day as it could have been, as earlier in the day it was trading below that -2% mark. The Dow continued its fall, falling 1.39% on the day, making it a week loss of just over 12%. Not all is bad though, because it didn't fall as far as it could have, as earlier in the day it was trading lower and recovered near the end. Surprisingly, the Nasdaq actually didn't have losses on the day and actually gained 0.01%. This is really surprising because throughout the day, except at this moment, it was trading negative at a decent amount as well. It shows that not all is bad and that there actually might be some positive things to come, and potentially this is a good time to actually buy into the market, as this might be the bottom of the dip. Europe and Asia couldn't escape the losses as well, with the FTSE dropping 3.2% and the Nikkei dropping 3.67%. A big loser for the day is oil. Oil continues its landslide, falling 4.33%, making it a week loss of 13.55%. It's hovering around that $45 level. It's hard to say if it will continue to fall or if this is as low as it's going to go. The big surprise, though, on the day, I'd say, is that gold fell a staggering 3.56%, as more money keeps flowing away from stocks, and it seems like it's not going to gold. Treasury rates keep dropping, and a lot of the money keeps going in that direction. Not too sure why gold's fallen, but overall, hard to say. With money continuing to flee the stock market and entering to safer assets like treasuries, the US 10-year has fallen a total of 13 basis points today, down to 1.14%. If you take a look, the 5-year, the 2-year, and the 12-month are all below 1%. It's just a matter of time now to see the US 10-year might drop down to that 1% mark. Canada's has also dropped a decent amount today, with the 10-year being at 1.1%. An interesting part about the Canadian yield curve, as you can see, that no part past the 3 months is actually above it. While at the US, you can see the 30-year is still above. Not exactly about treasuries, but there's also news about the LIBOR rates. It had its biggest drop since 2008. It fell a total of 11.8 basis points. Also, futures are also pricing in 86 basis points Fed cut this year, which is up from a week ago's 48. So people are really expecting that rates will continue to fall with all that's going on right now. In the currency markets, the big winner for the day is the Japanese yen, which had a really good day, rising above 1% versus all these currencies. The second is the euro. Euro had a pretty strong day, up against most of them except the yen. The Chinese yen also had a decent day, just not as well as the euro and the Japanese yen as well. On the downside, the British pound fell and the Australian dollar fell as well. The GDP numbers came out for Canada's fourth quarter last year, with the worst quarter in 4 years. Growth came in at 0.3% annualized. That's a pretty rough quarter for Canada, but it gets even worse there, with Q3's revision coming in at 1.1% from an initial 1.3%. This is due to household spending on services having an increase of 0.8%. Business inventory and machine equipment came in at negative 3.6%, which is the third decline in a row. As also, Exports volume decreased 1.3%. Overall, strikes, weather, and shutdown are to blame for this cause in lower GDP. This low GDP, though, is kind of concerning for the Canadian economy, especially when you take into consideration how the markets are performing currently. All stocks are down, things like that. The coronavirus is going to have some economic impact, as well as all the blockades going on in Canada couldn't have happened at a worse time. I expect that this first quarter is also going to be a pretty rough quarter for Canada and maybe even worse than this one. With this low GDP growth and concerns over the economy going forward, it begs the question, will the Bank of Canada end up lowering rates from the 1.75%? Their next meeting is on Wednesday. Based off this poll by Reuters, that they found that roughly 60% of respondents, which total of 20 out of 34, expect that it will leave unchanged until near the end of 2020. This is down. Previously, it was at 70%. I know RBC actually just came out saying that they expect that there will be a rate cut happening at this meeting. But overall, 4 out of 5 of the big banks expect that at least one cut will happen in 2020. And actually, 6 out of 34 expect that one will happen at this meeting go forward. I expect that there is a chance that will happen, especially with the lowering of treasury bills. The 10-year in Canada is near that 1%, which is significantly lower than the overnight rate, and they might be almost forced to lower rates. Moving on to Europe, in Germany, their unemployment number came out at 5%. That's the same level as it was before. And overall, it's a decent number to have. But what's a little concerning is that in the past quarter that they had zero economic growth, and for the whole last year, they only achieved a 0.6% increase over the whole year, which is pretty concerning for the whole area and the impact going forward if the labor market will be able to be this good or might have issues, especially with stock slumping, markets going down. It could have a negative impact as well as bring up that unemployment rate. The Brexit drama just never seems to end, with France coming out making fun of the UK. Basically, what's going on is the UK is wanting a similar deal to Canada, where they get about 98% of tariffs removed, so no duties on those goods, and that they're hoping to get that. And Boris Johnson came out saying that they're giving them a 4 month time period, while Europe is saying that that's not going to happen. It seems like they're very reluctant and that they actually expect it will be even longer. They even expect that it will probably take longer than a year overall. Kind of one of the big things that the EU wants UK to do is to sign up to their competition rules so that they have the same competition. They say it's because UK is closer to Europe. Overall, I feel like EU just kind of wants to keep their grasp over all of Europe and have total control and remove as much power from the UK that they can. Unfortunately, the coronavirus continues to spread and not primarily in China, which is most concerning. As you can see, total cases in China only increased 335, while in South Korea it was 571, Italy 233, and Iran 143. This means that the virus isn't being contained in China and is spreading to other places. This has led Switzerland to cancel large events. So any event with 1,000 people or more will be put off until they update it in March 15th. It's also led Germany to quarantine about 1,000 people to try and stop the spread. In total, there are 84,169 cases and deaths of 2,876. The virus isn't the only thing that's going on in the world right now, as tensions between Turkey and Russia rise. So what happened is there was an attack going on in Syria that ended up killing a total of 33 Turkish soldiers. There is some speculation that Russia was involved, as that's what Turkey believes, at least. What Turkey now is threatening, though, is that they will have an increase in migrants and refugees going over there, and that they will actually loosen the policy of preventing migrants entering Europe, which seems like a strange result to happen from this. I'm not sure why Turkey would be punishing Europe for something Russia did, especially with all the tensions between Europe, US, and Russia going on in the past few years. Moving on to company news, the boy wonder company Beyond Meat had a really bad day. Overall, their stock is now down over 17% based off their quarterly results. What the strange part about this, though, is that they achieved revenue of 98.5 million, which is higher than all analyst expectations. Over the year, they achieved total revenue of 297.9 million. Though this is really concerning if you think about the market cap. Their total market cap is about 5.4 billion. So overall, it's earning expensive stock. The question here, though, is why is it falling so far when they beat expectations? It's kind of speculated that people were hoping for more, possibly a higher revenue growth. I think a lot of people just kind of got on the hype train of it's going up, they're just going to do amazing, and all things like that. Another reason it could possibly be is that their expectation for the coming year is to have an adjusted EBITDA margin similar to this year. They had 8.5% this year, which isn't staggering high, especially when you compare their market cap to the revenue and then compare it also to their EBITDA. They are a very expensive stock, but overall, you kind of got to expect this to be in the long run decision, as people expect that more vegetarian burgers will have a bigger share of the market going forward. Laurentian Bank, one of Canada's small banks, also reported their Q1 earnings for the year, and they had an abysmal quarter. This doesn't really go well for them, especially if you consider how the other Canadian banks performed overall. For example, their earnings were 32.2 million, down from 40.3 million the previous year. Earnings per share were 68 cents, down from 88 cents. Adjusted earnings per share were 79 cents, down from 98 cents. And analysts actually expected that they'd earn $1.08 per share. So overall, really rough quarter for the bank, and I guess might have to do with the size of the bank. But overall, comparing it to the other banks, it's really not a good look for them going forward.